Today, a staggering $650 billion vanished in a matter of hours. If you were watching the digital tickers on your screen, you witnessed what looked like a total capitulation. Silver, the metal often called the gold of the poor, experienced a violent free fall from $83 down to $71 per ounce. That is a 14% drop in a single trading session. To the average retail investor, this looked like the end of the road. It looked like a bubble bursting. Panic spread through message boards and brokerage accounts as stop-loss orders were triggered and fortunes were wiped out in the blink of an eye. But while the Western world was watching a digital massacre, something very different and very strange was happening on the other side of the planet. As the paper price of silver in London and New York was crashing towards $70, physical silver on the Shanghai Gold Exchange was trading at $89. Let that sink in for a moment. At the exact same second in time, for the exact same chemical element, there was a $17 price gap. This is not just a minor market inefficiency. This is a massive, screaming neon sign that the global financial system is fracturing. We are witnessing a historic divorce between the digital world of promises and the physical world of reality. This $17 spread represents a 24% premium for physical metal over the paper contracts traded in the West. In a normal, healthy market, such a gap would be closed in seconds by arbitrage traders. They would buy the cheap silver in New York and sell it for a profit in Shanghai. But that is not happening. The gap is not closing. In fact, during the height of today's crash, the gap actually widened. This tells us that the $71 price you see on your screen is an illusion. It is the price of a piece of paper that says you own silver, but it is not the price of the actual metal that you can hold in your hand. The buyers in Shanghai are not fools. They are not overpaying. They are simply paying the real market price for a physical asset that is becoming increasingly difficult to find. We are entering a period of extreme market volatility where the rules of the game are being rewritten in real time. For the last several decades, the paper markets have dictated the price of commodities. A few clicks of a mouse could dump millions of ounces of virtual silver onto the market, suppressing the price regardless of how much metal was actually in the vaults. But that era of digital dominance is coming to an end. Today's $650 billion crash was not a reflection of silver losing its value. It was a reflection of a paper system under such immense stress that it had to undergo a violent liquidation to survive another day. In this video, we are going to go behind the curtain of this collapse. We are going to examine the mechanics of how this price was engineered and why the physical market is refusing to follow the downward spiral. This is about more than just a price drop. It is about a fundamental shift in the global economic order. By the time we are done, you will understand why 99% of investors are looking at the wrong numbers and why the next 72 hours could define the future of your wealth. To understand why a $17 gap exists between New York and Shanghai, we must first understand the fundamental illusion of modern commodity markets. Most people believe that when they buy silver through a brokerage account or an exchange-traded fund, they are buying a piece of metal. But in reality, they are usually buying a paper promise. This is the great divorce between the financial world and the physical world. In the financial world, silver is just a ticker symbol, a digital contract that can be created out of thin air with the stroke of a key. This is what we call paper silver. Imagine for a moment that you want to buy a car. You have two options. You can go to a dealership, pay your money, and drive a physical vehicle home to your garage. You have the keys, you have the title, and you have the physical object. Or you can go to a financial exchange and buy a piece of paper that says you own one car. The exchange tells you they will hold the car for you, but they do not tell you exactly where it is or if that same car has been promised to 10 other people. Most people in the stock market are unknowingly choosing the second option. They are trading promises of silver, not silver itself. The scale of this paper market is astronomical. On major exchanges like the COMEX, the volume of paper silver traded in a single day often exceeds the total amount of silver produced by all the mines in the world in an entire year. This is only possible because the system operates on a critical assumption that most investors will never ask for their metal. As long as everyone is happy to settle their trades in cash, the system works perfectly. You buy a contract at $20, the price goes to $25, you sell the contract, and you pocket the $5 profit in paper currency. No physical silver ever moved. No vault was opened. It was a digital bet. However, a crisis occurs when the holders of those paper contracts suddenly lose faith in the paper and start demanding the physical metal. This is what is known as a run on the exchange. Because the market is an inverted pyramid, there are hundreds of paper claims for every single ounce of physical silver sitting in a vault. If even 5% of paper holders demanded delivery at the same time, the system would collapse instantly because the physical metal simply does not exist in those quantities. This is exactly what the price divergence is signaling right now. The $89 price in Shanghai is the reality of physical demand. The $71 price in the West is the desperate attempt of the paper market to maintain control. When you see the paper price crash while the physical price stays high, you are witnessing a breakdown in the delivery mechanism. The paper market is no longer reflecting the value of the commodity. It is reflecting the lack of liquidity and the desperation of those trapped in a leveraged system. We are moving toward a moment of truth where the holders of paper will realize that a promise of silver is not the same as silver you can hold in your hand. In the next section, we will look at the specific weapon used to trigger this latest crash, the margin hike. To the uninitiated, today's 14% crash looked like a natural market reaction. But for those who understand the inner workings of the futures exchanges, this was a calculated execution. The primary weapon used to trigger this collapse is something called a margin requirement. In the world of high finance, most traders do not buy silver with 100% cash. Instead, they use leverage. They might put down $5,000 to control $100,000 worth of silver. That $5,000 is their margin. It is the collateral that keeps their position alive. Last Friday, as the markets were entering a quiet holiday period, the exchange announced a sudden and significant increase in these margin requirements. For silver, the requirements were hiked by 13.6%. On the surface, the exchange claims this is a move to manage volatility and protect the system, but the timing tells a different story. They chose to strike during a holiday window when liquidity is at its lowest point of the year. Many institutional desks are run by skeleton crews, corporate treasuries are closed, and bank wire transfers are delayed. When the exchange demands more cash immediately, many traders find themselves in a trap. It does not matter if they believe silver is going to $100. It does not matter if they have the money in another account. If they cannot get the cash into their trading account within hours, the exchange's computers automatically liquidate their positions. They are forced to sell at any price available. This creates a domino effect. As the first group of traders is forced to sell, the price drops. This drop triggers the stop-loss orders of the next group, which drives the price even lower, leading to more margin calls. This is a man-made vortex. In this environment, the price is not being driven by the fundamental value of silver or industrial demand. It is being driven by the mechanics of forced liquidation. The metals with the highest margin increases today, platinum and silver, were the ones that fell the hardest. Platinum margins were raised by 23%, and it subsequently collapsed by 13.5%. This is not a coincidence. It is a mathematical certainty. By raising margins during a period of low liquidity, the powers that be can effectively shake the tree. They flush out the leveraged speculators and the retail traders who cannot meet the cash calls. This allows the big players who have deep pockets and direct access to the clearinghouses to buy back those same positions at a massive discount. While you see a terrifying red candle on your chart, they see a fire sale that they engineered. The most important thing to remember is that while the paper price was being manipulated downward by these margin hikes, not a single ounce of silver became less useful or less rare in the real world. In fact, as we will see in the next part, the physical market ignored this paper theater entirely. While the Western paper markets were locked in a downward spiral of forced liquidations, the East was sending a completely different message. To understand the future of silver, you must stop looking at New York and start looking at Shanghai. The Shanghai Gold Exchange, or SGE, operates on a fundamentally different philosophy than the Western exchanges. In the West, most trading is done for speculation, and cash settlement is the norm. In Shanghai, the market is driven by physical delivery. When you buy a contract in Shanghai, there is a much higher expectation that real, physical metal will move from one vault to another. Today, the world witnessed an unprecedented event. While the paper price in the West touched $71, the physical price in Shanghai held firm near $89. This $17 gap is the largest in modern history. Why would Chinese buyers pay 24% more than the price on a New York screen? The answer is simple and terrifying, because they know the $71 price is a lie. They understand that if they tried to buy millions of ounces of physical silver in the West at $71, they would be met with silence. The metal is simply not there at that price. China is currently the world's largest consumer of silver, driven by its massive solar panel industry and electronics manufacturing. For them, silver is not a digital toy. It is a critical industrial bloodline. They are witnessing the same disappearing inventories that we see in Western vaults, and they are reacting rationally. By maintaining a high price, the Shanghai market is acting as a giant vacuum cleaner, sucking up the world's available physical supply. If you are a silver miner in Mexico or Peru, where would you send your metal? Would you sell it to a Western exchange for $71 in paper, or would you ship it to Shanghai for $89 in hard currency? This is a drainage of Western wealth in real time. For decades, The West has used the paper markets to suppress the price of commodities, allowing them to acquire raw materials cheaply. But the East has caught on to the game. By paying a premium for physical metal, China is effectively breaking the pricing power of the COMEX and the London Bullion Market Association. They are forcing a relocation of the world's silver stocks from west to east. Furthermore, the Shanghai signal tells us that the global market is bifurcating. We are moving toward a two-tier system. One tier is the Western paper market, which is becoming a casino for speculators and high-frequency trading algorithms. The other tier is the Eastern physical market, which is becoming the true center of price discovery based on real supply and demand. The $17 spread is not an error. It is the cost of reality. As long as this gap exists, physical silver will continue to flow out of Western vaults and into Eastern hands until the Western exchanges are left with nothing but empty vaults and mountains of worthless paper contracts. To truly grasp the gravity of the current silver crash and the divergence in Shanghai, we must look back at the scars of market history. What we are seeing today is not a random glitch. It is a recurring pattern that emerges whenever the paper world tries to suppress the physical reality. The most famous example occurred in 1980, orchestrated by the Hunt brothers. Nelson Bunker Hunt and William Herbert Hunt realized that the paper currency was being devalued and that physical silver was the ultimate hedge. They began buying massive amounts of silver and, more importantly, they started taking delivery of the physical metal. As they drained the vaults, the price of silver skyrocketed from $6 to nearly $50 per ounce. The establishment panicked. To stop the surge, the exchanges changed the rules in the middle of the game. They implemented Silver Rule 7, which restricted traders to liquidation only and drastically increased margin requirements. This is exactly what we saw today. By changing the rules, they broke the hunts and sent the price crashing back down. The lesson was clear. When the physical demand threatens the system will change the rules to survive. Fast forward to March 2022, and we see a more recent echo in the nickel market. A massive short position held by a Chinese stainless steel giant was caught in a squeeze. As the physical price of nickel doubled in a single day, surpassing $100,000 per ton, the London Metal Exchange did something unthinkable. They did not just raise margins. They halted trading and canceled thousands of valid trades. They effectively erased billions of dollars in profits to protect the banks and brokers who were on the wrong side of the physical reality. Today's silver market is showing the same symptoms of a terminal systemic failure. The $17 gap between paper and physical is the same kind of pressure that led to the nickel collapse. In 1980, it was two wealthy brothers. In 2022, it was a single industrial giant. Today, it is an entire nation, China, refusing to play by the Western paper rules. History shows us that whenever a massive gap opens between the price of a paper promise and the price of the actual asset, the paper market eventually breaks. Whether it is through a rule change, a trading halt, or a total default on delivery, the conclusion is always the same. Those holding the physical asset are the only ones who survive with their wealth intact. The paper price can be manipulated to zero, but the physical silver will always have value because the world cannot function without it. As we move into the next part, we will explore why the modern world is more desperate for silver than it was in 1980. The primary reason why the paper price crash is an illusion lies in the industrial reality of the 21st century. In 1980, silver was primarily a monetary asset and a component for photography. Today, silver is an industrial black hole. It is the most electrically conductive, thermally conductive, and reflective metal on the periodic table. There is no substitute. Because of these unique physical properties, silver has become the essential nervous system of the modern world. Every solar panel, every electric vehicle, every 5G base station, and every high-end electronic device requires silver to function. The green energy transition is particularly hungry for this metal. A single solar panel contains approximately 20 grams of silver. As the world races to meet carbon neutrality goals, the solar industry alone is projected to consume more than 80% of the world's silver production by the year 2050 if current trends continue. We are not just talking about a luxury investment, we are talking about the foundation of future energy. Furthermore, electric vehicles use nearly double the amount of silver compared to traditional internal combustion engines. Every battery management system and every sensor in an autonomous car relies on silver's reliability. We are currently living through a massive structural deficit. For the past several years, global silver demand has consistently exceeded silver supply. According to the Silver Institute, the world silver market has been in a deficit for 3 consecutive years, with 2023 and 2024 seeing some of the largest shortfalls on record. The world is consuming hundreds of millions of ounces more than the mines are producing. This gap is being filled by drawing down above-ground inventories, but those inventories are not infinite. The most critical point to understand is that silver production cannot be turned on like a faucet. Approximately 70% of silver is produced as a byproduct of mining for other metals like copper, lead, and zinc. This means that even if the price of silver goes to $100, miners cannot simply produce more silver without also increasing their production of those other metals. It takes an average of 10 to 15 years to bring a new mine from discovery to production. The industrial users, the Apples, the Teslas, and the Samsungs of the world are starting to realize that the paper price is irrelevant if they cannot secure the physical metal for their assembly lines. If a solar panel manufacturer cannot get silver, their billion-dollar factory stops. They do not care if the paper price is $71 or $89. They only care about availability. This is why the Shanghai price is so much higher. The East is securing the physical metal to fuel its industrial dominance, while the West is busy trading paper contracts that represent silver that has already been consumed by industry. To visualize the fragility of the current silver market, you must imagine an inverted pyramid. At the very bottom, the smallest point, sits the physical silver. This is the tangible metal held in the vaults of the COMEX, the London Bullion Market Association, and the Shanghai Gold Exchange. This is the foundation. Above this tiny point, however, the pyramid widens out into massive layers of paper claims. The first layer above the physical metal consists of fully allocated accounts, where specific bars are assigned to specific owners. Moving further up, we find unallocated accounts, where you have a claim on silver but no specific bars are yours. Then comes the massive layer of futures contracts, followed by options on those futures, and finally, complex derivatives and exchange-traded funds. In a stable system, the amount of paper should be reasonably linked to the amount of physical. But today, it is estimated that there are between 100 and 500 paper claims for every single ounce of physical silver in existence. This structure works perfectly during times of peace and confidence. It allows for high liquidity and easy trading. But an inverted pyramid is inherently unstable. It depends entirely on the assumption that only a tiny fraction of people will ever ask for their physical metal at the same time. This is the definition of fractional reserve banking applied to a commodity. As long as everyone is happy with their digital digits on a screen, the illusion holds. However, we are now seeing the cracks in the foundation. The $17 price gap we discussed is a signal that the weight of the paper claims is becoming too heavy for the physical base to support. When the price of silver began to rise toward $83, it created a panic among the institutions that have sold these paper promises. They realized that if the price continued to climb, more and more people would sell their paper to buy the physical, or worse, they would demand delivery of the metal they thought they already owned. Today's margin hike was a desperate attempt to shrink the top layers of the pyramid. By forcing speculators to sell their paper contracts, the exchanges reduced the total number of claims against the physical vaults. It was a systemic reset designed to prevent a total collapse. But here's the problem. While they can reduce the number of paper contracts, they cannot increase the amount of physical silver. The base of the pyramid is still shrinking as industrial demand eats away at the remaining supply. We are approaching a mathematical breaking point where the inverted pyramid will simply tip over, and the world will discover that most of the silver they thought they owned was nothing more than a digital ghost. As the divergence between paper and physical markets reaches a breaking point, we are witnessing the emergence of a new phenomenon, the economic Iron Curtain. In the last few days, several major silver-producing and refining nations have begun implementing strict export controls. This is a move that should send a chill down the spine of every Western investor. When a government restricts the export of a commodity, it is a clear admission that they believe the global market is broken and that domestic supply must be protected at all costs. Historically, silver has moved freely across borders, flowing to wherever the price was highest. This is what kept global prices in check. But now, that flow is being choked off. Countries like Peru, Mexico, and even certain Asian jurisdictions are prioritizing their own industrial needs over the international market. They are looking at the massive demand from solar energy and electric vehicle manufacturing and realizing that silver is more valuable as a strategic resource than as an export for paper currency. The implications of these controls are profound. In the past, if the price in Shanghai was significantly higher than in New York, traders would simply ship metal from the United States to China to capture the profit. This arbitrage would eventually bring the prices back into balance. But with export controls in place, that bridge is being demolished. The $17 gap we are seeing today is becoming permanent because the physical metal can no longer move to where it is needed most. We are entering a world of balkanized markets, where the price you see on your screen in Chicago has zero relevance to the price you would pay in a silver-producing nation. This is a nightmare scenario for the Western paper exchanges. If they cannot source physical metal from global markets because of export controls, they lose their ability to satisfy delivery demands. The COMEX and London markets depend on a global supply chain that is now fracturing. For the industrial giants in the West, this means that the silver they need for their assembly lines is being trapped behind national borders. We are seeing the death of globalization in the precious metals space. As nations begin to stockpile silver like they once stockpiled oil or wheat, the paper price becomes even more of a fantasy. The export controls are the ultimate proof that the physical shortage is real, and that governments are preparing for a future where silver is one of the most contested resources on Earth. In this environment, owning physical silver within your own jurisdiction, under your own control, is no longer just an investment strategy, it is a necessity for wealth survival. The chaos we are witnessing in the silver market has created a violent divide between two types of market participants, the speculators and the accumulators. Understanding which group you belong to will determine whether today's $65 billion crash is a personal tragedy or a generational opportunity. The speculators are those who trade silver on screens. They use high leverage, they watch minute-by-minute charts, and they rely on the integrity of the paper system. For this group, today was a bloodbath. When the exchange raised margin requirements, it was a direct attack on their survival. Speculators are forced to play a game where the house can change the rules at any moment. Because they do not own the metal, only the price movement, they are vulnerable to the shakeouts engineered by big banks. If you are trading paper silver with leverage, you are not an investor. You are a gambler in a casino where the dealer can see your cards. On the other side are the accumulators. These are the individuals who understand the fundamental deficit and the industrial necessity of silver. They do not buy contracts. They buy coins, rounds, and bars. For an accumulator, a 14% drop in the paper price is not a loss, it is a sale. They look at the $89 price in Shanghai and the $71 price in New York and realize that the Western market is offering a massive discount on reality. Experienced accumulators follow a specific playbook during times of extreme volatility. First, they ignore the noise of the paper price. They know that as long as they hold the physical ounces, their wealth is preserved, regardless of what a digital ticker says. Second, they focus on ounce counting rather than dollar value. If you had 100 ounces yesterday and you have 100 ounces today, you have not lost anything. In fact, if you bought 10 more ounces at the $71 illusion price, you have increased your position in the real world. The most important strategy for the accumulator is the elimination of counterparty risk. By holding silver physically, you are no longer dependent on a broker's solvency, an exchange's rules, or a bank's honesty. In a world where the inverted pyramid of paper claims is beginning to wobble, being outside of that system is the ultimate hedge. As the gap between paper and physical continues to widen, the speculators will continue to be liquidated, while the accumulators will be the only ones left standing when the paper markets finally face their day of reckoning. As we stand at the end of 2025, the events of this massive price crash have brought us to a historic crossroads. The $65 billion evaporation in market cap and the $17 gap between New York and Shanghai are not mere anomalies. They are the symptoms of a system that has reached its mathematical and physical limits. For decades, the illusion that silver is an infinite digital asset has allowed for suppressed prices and cheap industrial inputs. But today, as the year 2026 looms, reality is finally asserting itself. The silver market is no longer just about investment. It is about the survival of the green energy transition and the digital age. With China's new export restrictions taking effect on January 1st, 2026, the bridge between the paper promises of the West and the physical reality of the East is being burned. We are entering a two-tier world. In one tier, you have the paper price, a volatile, manipulated number used to shake out weak hands. In the other tier, you have the physical price, the real cost of the metal that fuels our solar panels, our electric vehicles, and our artificial intelligence infrastructure. The data for 2026 is clear. We are facing the 6th consecutive year of a structural supply deficit, with some estimates projecting a shortfall of over 200 million ounces. Above-ground inventories in London and New York have been drained by nearly 70% in the last 5 years. There is no quick fix. You cannot print silver, and you cannot build a new mine in a weekend. As industrial giants like Tesla and Samsung scramble to secure their supply chains, the price of real silver will continue to decouple from the paper tickers on your screen. The final reckoning is not a matter of if, but when. Whether silver hits the psychological $100 milestone in 2026 or undergoes further volatile consolidations, the underlying truth remains. The world needs more silver than it possesses. For the investor, the lesson of today's crash is simple. Do not be distracted by the red numbers on a screen. Those numbers are designed to make you panic so that the smart money can take your position. In the end, currency is a promise, but silver is a fact. As we move into 2026, the gap between those who hold the promise and those who hold the fact will become the greatest wealth divide in history. Stay rational, watch the physical premiums, and remember that in the battle between paper and reality, reality always wins. Thank you for joining me on this deep dive into the global financial engine.